And welcome back. In the previous video, we had an introduction to bonds and bond portfolios. In this session, we're going to move a little bit further, taking a look at some of the risk factors, some of the ways that we measure the risk, and also some of the ways that we can hedge risk with, well, mostly derivative strategies. We'll also have a brief introduction to international portfolios, international bond portfolios, and the risk involved with those. When we talk about measuring risk, typically we start off with a discussion of standard deviation. When we looked at this in our earlier corporate finance courses, the principal measure was the level of uncertainty, or the variance, the standard deviation. But when you think about bonds, and bond markets in particular, we're mostly concerned with one type of risk, and that's the downside deviation, the risk of a shortfall. So we'll look at tools like semi-variance and also value at risk. But first, what's wrong with standard deviation? Essentially, standard deviation starts off with the principal assumption that we're dealing with a normal distribution. And a normal distribution is normally distributed. In other words, that there's no skewness, kurtosis, that the tails of the distribution fit all the normal parameters. And typically that's not the case when we're looking at bonds. The upside in a bond investment is limited to market improvement, and there are a lot more downsides. So we're much more concerned about the negative side of the distribution. This is especially true if our bonds have got special features. For example, call options, inflation premium, and things like that can create a non-normal distribution. So we more typically look at the variance on the downside. Here we're talking about semi-variance. Essentially, this is a measure or a way of reporting the dispersion of outcomes below the target rate of return and ignoring the part that's above. It works better than variance or standard deviation because typically in bond investments we're only concerned about the downside risk. Semi-variance by itself is not used as commonly in bonds as it is with equities, and later on with equities we'll talk a little bit about measurements of downside deviation, and it's partly because it's difficult to produce the conclusions or produce the the full range of outputs, because our inputs, the data, is going to be reduced. We're only dealing with half of the variation, and so our sample size is half as small. Two different ways that we'll look at this. We'll talk a little bit about shortfall risk, or the probability that the returns from our bond portfolio will not meet the requirements of the liabilities that they're set up to cover. And the other thing we'll look at is a tool that was developed by PhD students who are working together with JP Morgan, and they developed a tool called value at risk. And value at risk is a way of estimating the potential dollar loss if things work out badly. What is the worst that can happen in our 1% worst bad day? If we think about a distribution, and here we're still looking at a normal distribution, but we can adjust in the model for non-normal distributions as well. If we expect that the value of our asset is going to be, as in this example from one of my books, we expect that normally the asset is worth $80, or €80 in this case. If we think about what a really bad day could look like, what is the 1% of our worst days look like? What's the 1% tail of our distribution look like on a really bad day? Here we'd say there's a 1% chance that the price of our bond is going to fall below €23 and 30 euro cents. And we get that by essentially taking 2.33 standard deviations times the measure of one standard deviation. If our single standard deviation is 10%, 2.33 times 10% means that the value of our investment, our bond, could fall from €80 to 56.70. It could fall by 23.30 in that 1% worst possible day. The calculation is shown in the yellow box, so essentially it's the starting price minus 2.33 standard deviations, which is essentially the measure of the 99th percentile in our distribution, times the measure of standard deviation, that small sigma. A calculation with slightly different number set shows exactly how this would work with a bond portfolio. Again, from another book that I wrote for bankers. And it essentially says that if we have a starting state, if our bond has a BBB credit rating, there's an 84.26% chance that at the end of the year, it's still going to be an 84.26, still going to be a BBB rating. The chance of no rating transition is 84%. There's a chance that it could be upgraded to an A, and that's 4.56. Getting upgraded 2 steps is improbable. There's only 0.25% chance of that, and the chance of moving up to a AAA is really, really small. The chance of a downgrade to a BB, quite a significant downgrade, because that means we'd now be in the junk bond range. There's a 4% chance of that, a 0.76% chance that it's going to fall 2 slots, and so on. Now, we actually get these transitions by observing the behavior of BBB rated bonds over the last 10 years, let's say, and we'd say that of all of the BBB bonds, a very small percentage of them move more than one rating band in a particular time period. So for the next year, we'd say it's highly likely we're still going to be at an 84, at a BBB rating, an 84% chance of that. Now, the value of our bond right now is $107.88, and that's what the rate would be based on a BBB rating. If we got upgraded to a AA or to a single A, that means that our bond price would go up to $108.78, and if it went up to a AA, it'd go up to $109, and so on. If it went down, it would drop to $106, $103, and so on. So these prices, the value of a loan or the value of a bond, is going to depend on the quality of the underlying credit. More valuable if it's a better credit. The probability weighted value is the probability, 84.26% times 107, so that's where we got the 90.99. This green column is just the value that's in the yellow column beside it times the probability. And then the next thing we get is that the difference of the value from the mean. Now we see the sum of all the probability weighted values is 101.72. Essentially, that's how much we would pay for that bond. And the difference between 101.72 and the mean value, or the value that we have and the mean value, so 107.88, the yellow bar, minus 101.72 is $6.16. And so this gives us the value of our difference from the mean. And of course, the difference from the mean, the difference from the expected observation, is our measure of variance. And we can use that to calculate the probability weighted difference squared. So here we can take the difference from the mean, square it, and multiply it by the probability, and that gives us these values in this box. The sum of all of these values is our variance, and the square root of that is our standard deviation. All of that gives us the 2 bits of information that we need in order to calculate the value at risk. We need to know the mean value, and we need to know the standard deviation. If we have a 5% value at risk, in other words, what does the worst 5% of all of our days look like? That would be 1.65 standard deviations away from the mean. And so 1.65 times 6.03% means that in our worst 5% of days, the worst 1 day out of 20, the value of our investment could fall by almost $10, $9.94. And in our worst 1%, the worst 1 in 100 days of the year, it could fall by 14.04. 2.33 standard deviations away from the mean. So that's our calculation. It's not really important that you memorize this, because of course you can always look this up if you need to know it later, but you need to understand the intuition behind value at risk. All financial institutions are required to report on their value at risk now. It's part of the marking to market process that we hear about when we're talking about the the riskiness of a bank's assets, something that became much more common after 2008 with the financial collapse and the more careful scrutiny, especially of banks that are considered to be systemically important. Now you can see here, for example, if you look at the most recent results from Scotiabank, that they report the value at risk that's put at risk because of certain types of activity of the bank that create that market risk that they need to report on. Things like lending activities requires some value put at risk, so they talk about their own credit spread. Equity investments that they carry on behalf of their own clients as well as themselves, foreign exchange, commodities, any kind of debt-specific value at risk. These are things that they've added up, and they take away the diversification because some of the interplay of those type of assets is self-immunizing, so they've removed that from the total amount. And that says that the all-bank value at risk at the year end, for example, in 2020, was $14.6 billion. And that the all-bank stressed value at risk, well, according to a particular stress test in a very particular scenario, could be as high as $37 billion. This is something that's tracked on a regular basis. It's constantly marked to market because conditions change, and what the worst possible 1% of days looks like varies over the year. In this particular chart, they're talking about the market risk based on their trading activities, mostly trading in equities, but also bonds and some derivatives. And they'd say that on a normal day, the red line represents the revenue on a normal day. So on these days in November and December of 2019, you can see that they would on a good day get about $20 or $25 million in revenue, and they could perhaps make nothing at all. But by the time we get to March, when things are going a little bit crazy because of the pandemic response of the market, we can see the volatility increases. We've talked about this before. So a much more volatile market. On good trading days, they're making $50 million or $40 million in trading profits, but on bad days, they have significant losses. So trading activity, a certain amount of volatility, the more volatility, the greater the value at risk. And that's the black line. You can see that the possible loss from a 1% bad day, let's say value at risk 99% percentile, per day, their value at risk on any one day could be $20 million loss, and then they go through till March, and on a bad day, according to the revised model, it could be as much as $60 million in one day. So this is how an organization like Scotiabank, in fact, all of the systemically important banks, reports their value at risk. Portfolios of bond funds will also be able to calculate the value at risk. In fact, it's very easy because this is now a program that is in the public domain. Part of the reason that JP Morgan did that was because they wanted to create an industry standard. And they've done it to the extent that it is essentially regulated and required by most of the bank regulators. Now, those are a couple of the measures of risk. We can talk about variance, shortfall risk, semi-variance, the value at risk model. Once we've identified those risks, how can we protect ourselves from those risks? Well, obviously, the first thing that we do when we're thinking about protection is just not to do it in the first place. But that's not practical because we have to invest. We have to put our money into something, and bonds are less risky than most of the alternatives. So with the risk that remains, the residual risk, what can we do? Well, we can pass that risk on to somebody else by going into some kind of a partnership, or we can buy insurance. And essentially, contractual measures like derivatives are insurance against those losses. And that's what we're doing here. Some of the best known are things like futures and financial futures, things like interest rates and currency rates, futures and swaps are very commonly used. They're the biggest markets and the oldest markets after the agricultural commodity markets. Interest rate swaps allow us to change the duration of investments. We won't be talking much about those. We'll look at those a little bit later when we talk about risk management. Option contracts, either based on the underlying bond contracts, which is the principal asset, bonds, things like bankers' acceptances, for example, are used as, and even repos, are used to price options. Or there are also the futures markets, the interest rate futures markets, and there's option trading based on futures markets. A little bit more on that later. So some of these physicals, as well as the derivative, if you like, the second derivative markets, include things like credit options, credit derivatives, credit forward contracts, and credit default swaps. And then after that, we've got several other types of very imaginative products that are constantly being invented and reinvented. Things like mortgage-backed securities, asset-backed securities, collateralized debt obligations. Even things like student loans can essentially be collateralized and traded as a hedge against certain types of risk, or a way of getting extra risk exposure if you're looking for that kind of risk. Futures are, again, the most common form of ways of hedging against risk. Essentially, they offer an advantage to investing directly in the market for those bonds in order to control duration. In other words, if I want to control that risk, I can buy a lot of short-dated bonds to shorten the duration of a portfolio, or I can use very short-dated futures or even a short position in futures markets in order to shorten the duration of my bond portfolio. Most commonly, these things are used for adjusting the duration, especially if we expect that we're going to face particular types of interest rate risk and sometimes market risk. The type of measures that we use, targeting dollar duration, we've introduced that topic, although duration and calculation is outside the scope of this course. The dollar duration of futures contract, essentially based on the value of the contract, the total number of contracts times the duration that's reported. And we can also adjust these by using a different number of contracts. Number of contracts is target duration minus the initial duration, multiplied by portfolio, the total risk-weighted exposure, divided by the dollar duration per futures contract. Now, the way that we immunize or protect our portfolio using futures is essentially to identify the difference between the spot market price, and we also call that the cash price, and the futures price. If it's a very narrow or wide amount of difference, well, that's described as basis. So the difference between the spot and the future price is basis. Essentially, basis risk is the chance, the probability that basis will change unpredictably between the time that we enter into our contract and the time we need to cash in. For example, new information might actually change the difference between the forward price and the spot price dramatically. If the bond that is underlying the hedge is going to be different from the portfolio bond, then the basis risk can be substantial, and there's a chance that we'll end up losing more money on the protection than we had originally at risk. We also describe hedge ratios as essentially the percentage of protection that we buy. Do we go fully hedged or do we go partly hedged? The hedge ratio tells us how many futures contracts we need to buy in order to fully insure. And as often the case, we don't insure to the full extent because it's not practical or it's just too expensive. The way that hedges work can best be described or defined by using a payoff diagram. Here we have a payoff diagram for a short hedge. We have a short position in the underlying long futures contract. In other words, we already got the exposure. And so if the interest rates rise, we're going to take a loss because we've already agreed to a certain coupon rate, and no matter what happens in the market, our coupon rate is fixed, so the prices of our bond is going to go down if the interest rates go up. If interest rates fall, the value of our underlying asset goes up. So we have the payoff, or the value from for the instrument, on this vertical axis, and on the bottom axis, across the bottom, we have the interest rate. Now, the way that we can hedge this is to buy a futures contract. Go long in whatever the interest rate contract is. So if we go long in 180-day or 3-year or 5-year government bonds, that would be our hedge. We're entering into an agreement to buy those at some point in the future. So if interest rates go up, then we're going to make money from the hedge, and that's going to offset our losses in the underlying market. We don't have to go 100% hedged, and if we did go 100% hedged, essentially our payoff would be this vertical line. We would end up with no loss and no gain. So typically, we'll have a partial hedge, and so this leaves us with a net exposure. So if our hedge line wasn't quite as steep as the short position and the underlying was, we have still got some exposure, but it's a lot less. So if the interest rates rise, if our expectation of interest rates rise, we're going to lose a little bit. We're not going to lose a lot. And if interest rates fall, well, we're going to gain by a little bit. We're not going to gain by so much. Now, that's why we often describe this kind of investing as a zero-sum game. Now, we have exactly the opposite position for a long hedge. In this case, we have a long position. We've already got exposure to whatever is underlying. And so for this, we're going to hedge by using a short futures contract. If the interest rates go up, the value of our investments are going to go up. And so, yeah, we definitely would be very happy to see an interest rate rise. If interest rates fall, we'd end up losing money. So the short hedge means that essentially we're in a selling position for that type of underlying bond instrument. And again, if we decide not to fully hedge, we maintain a limited amount of exposure, then we're going to end up with some net exposure, some net gain if the interest rates rise, and if interest rates fall, we'll end up with a little bit of loss. We'll talk a little bit more about the nature of futures contracts a little bit later in the course. Now that takes us on to options. Now the key difference, of course, between a futures contract and an options contract is that futures contracts are a two-way bet. You're betting that something's going to go up, but if things go badly, you lose. So options, on the other hand, are more like buying an insurance contract, that if things go well, you're going to get paid off by the option contract. But if they go badly, you walk away from the option contract. You only lose the premium. Just like an insurance policy, if you insure your car and nothing happens during the year, you've lost the premium. If you get into an accident and your car's a write-off and it's worth $20,000, you're paid out the value of your car. You hope, if ICBC is going to behave well. In fact, the credit options markets are even more predictable than the options markets in cars, apparently. Call option is one that gives the buyer the right, but not the obligation, to buy a fixed income future contract at a particular strike price. And a put option gives you the right to sell the futures contract at the strike price. You also have these, as I said, in the cash market or spot market for things like bankers' acceptances, traded on the Montreal Derivatives Exchange, for example, in Canada, or on the Financial Futures Exchange in the United States, and there are more than one. We can also use options to essentially bet on the shape of the yield curve, the steepness or the flatness of the yield curve, and changes in the default rates, the credit spreads. The type of things that we try to use derivatives to control, different types of credit risk. Well, things like credit default swaps and credit default options are ones that essentially insulate us from the failure of a particular company. So default risk is the risk that the issuer is going to fail to repay. Credit spread is the risk that the credit instrument is going to be downgraded along with the company. Downgrade risk is the risk specifically that the rating agency is going to lower the risk on the issuer. Binary options only pay off if there's a specific negative event, for example, a missed interest payment. And credit spread options pay off based on the spread over the benchmark rate. Now, some of the ways that we get returns that are above the essential predicted yield on a bond instrument choosing the best markets in which to invest. Of course, we may see higher returns because of improved credit conditions in those markets, but also because of currency differences. Currency selection then becomes the next one. Changes in duration and yield curve management. Typically, the highest returns are from the longest duration. So lengthening the duration of an investment can improve the overall return to a bond, but only at the cost of increased credit risk and also interest rate risk. Choosing different sectors. Government, corporate, municipal government, foreign currency denominated, dollar denominated, those different types of sectors, and choosing essentially the winners can be part of our overall outperformance. Understanding the credit risk of the issuers better than the rating agencies, basically being able to outbet the rating agency, and investing in markets that are outside of the benchmark, the out-of-sample performance of our fund versus the bond market. Now, we'll also take a little bit of a look at international bonds and international bond markets, because especially if you're coming from a country outside the United States, most of the markets are going to be outside your domestic market. Canadian markets may only be 3 or 4% of total world markets, so we're always considering investments in international markets. The duration of a bond essentially measures the percentage change in value for a 1% change in interest rates. Interest rates go up by 1%, typically the bond value goes down. The duration is going to be an indicator or a measure of how much we're going to lose if there's an increase or a decrease in the interest rates. International rates, on the other hand, are not going to be perfectly correlated with the rates that are managed by our own central banks. And so we're always taking a little bit of a bet on the thinking of those other central banks. If you invest in several different countries, you're constantly observing what's happening in those markets, trying to predict the behavior of that country's central bankers and the domestic interest rates and also the exchange rates. You could essentially forecast that beta value that we talk about for equities in order to understand the expected volatility relative to our home market. For a domestic market, domestic portfolio, the percentage change is going to be attributable to the beta times the duration. And our bond weighting in the portfolio will also be affected by the average duration of the domestic portfolio times the country beta. Should we hedge international bonds? It's harder to hedge international bonds. It's easier to hedge currencies. You might be able to hedge some of the interest rates, but there's no total hedge against all of the risk on international bonds. Forward hedge, again, uses a forward contract between the bond currency and the home currency to protect us from unexpected changes in currency. And so if we look at our overall return, it's essentially the bond return plus the return from the currency. If we use a hedge, it's going to be the bond return plus the forward premium discount, or forward discount or forward premium. If we follow the interest rate parity rules that we discuss in international finance, and we discussed a couple of weeks ago in an earlier video, our hedged return is essentially going to be the same as the domestic return plus the bond's local risk premium. The law of one price essentially says that a bond that is marketable across borders will be made up of the real return plus the currency differential. We should hedge currency exposure when the expected change in interest rate is less than that differential between the domestic and the foreign short-term interest rates. Now, investing in not just international debt, but the debt of fast-growing, smaller markets is something that specialists tend to do. We see that some funds are initially focused or basically focused on those international markets. People like Goldman Sachs, for example, Jim O'Neill, famous for identifying the term BRIC, the Brazil, Russia, India, China, and all of the variations that have come afterwards as being markets of particular value, particular growth. Advantages to working with international markets. There's more diversification with those emerging markets than there are between developed countries. There's an increase in the availability of quality investments, those high grade or investment grade ratings. They have been resilient to financial crises, and we've seen most recently that China, throughout the entire pandemic, has managed to maintain growth because of the growth in consumer demand. Strong consumer demand tends to be much more important than the business demand, than business confidence. They can react quickly to negative economic events by cutting spending and raising taxes because the government economies are in many cases more centralized. Smaller countries have access to central bankers like the International Monetary Fund, the World Bank, European Development Bank, and so on. And several of those countries, especially countries like China, have very large foreign currency reserves and can afford to support their currency through a bad spell. Some of the risks in particular, more volatility, the distribution of the outcomes is is less likely to be normally distributed. We see skewness and kurtosis of the returns, that on average the returns might not be the expected mean that we'd plan to see. The mean, the median, the modal values may all be different. Lack of transparency in many cases, although that part is improving. Legal and regulatory infrastructure that we need in order to invest may be missing. The contracting process might not be as easy to understand as ours based on English common law. And a lot of countries have gotten into trouble because they've overborrowed in order to increase infrastructure, built lots of bridges to nowhere that when times turn bad result in default. So there may actually be that catastrophic default risk that we've seen happen over and over again in countries like Russia or Brazil, Venezuela, and so on. Now that's just a quick introduction to international bond markets, but we will come back to a little bit of that later when we're talking about international investments. When we're considering how to manage the investment of our portfolio, typically fund managers are not going to manage the bond portfolio themselves. They'll contract that to specialists who have a deeper understanding of fixed income markets and also access to the market makers. It's very difficult to find fund managers who can consistently beat the market. And that's because the market is so efficient. It's relatively transparent that usually we can only earn the expected rate of return less the transaction costs. So after adding in all of the fees for transactions and also for information, typically the rate of return for a fund manager is less than the average for the basic investment in bonds. We can use a type of style analysis, value versus growth versus emerging markets, and so on. And for that, we have to be able to construct a meaningful benchmark, which is not always easy to do. Then beyond that, we have got good selections, good choices of things to invest in. And from once we observe that certain investments have done very well, perhaps when we look at the variance or the semi-variance of that particular investment, we realize that we only got a higher return by taking on higher risk or more currency risk, more default risk, and so on. We should also take a look at the investment process, the methods used, and the things that are used to create that exceptional return, the alpha. And we look for the correlation of alpha, the similarity between managers who've been able to produce or outproduce the market rate of return, and avoid investing in managers who use the same source of the abnormal returns because, again, their source of alpha is essentially identical. We want diversification. Well, these two videos have covered a lot of material and some of it quite complex. We are not offering a course in fixed income as part of this program, but instead we're just taking a look at the portfolio effects. So if you really want to understand fixed income, you need to take a course in fixed income. We talked a little bit about whether or not bond portfolios should be benchmarked against specific liabilities or against a benchmark of all bonds, all corporate bonds, all government bonds, the entire universe of bonds, country markets, and so on. We introduced the concept of repurchase agreements, very short term typically, fully collateralized instruments that are commonly traded. We did this in the first video. We talked a little bit about a basic immunization strategy, a bit about rebalancing our portfolio based on things like dollar or spread duration. And in this video, we focused more on portfolio risk, measurement of those risks, and strategies using derivatives. A brief introduction also to international bond portfolios and management of risks in international portfolios. As I mentioned earlier, an introduction to the topic. Please take a look at the chapter 6 in our textbook, and I look forward to talking to you in the next series of videos where we'll look at equity markets. Thank you very much.